We'll have to educate her someday.
All right, let's talk to these markets here. Let's talk technology in these markets. Is technology still a leader for these equity markets as it has been forever? Shana Sissel joins us. She's the president and CEO of Banríon Capital Management, joining us here. Shana, a couple of weeks ago, it seems like a lifetime ago, there's this thing we all learned about, DeepSeek. And I know you guys spend a lot of time thinking about investing in technology, broadly defined. How did you guys think about this DeepSeek and what it may mean for technology investing?
So my general rule of thumb with any kind of news is if it makes me have a very visceral response, that I should step back and read. And so that was my initial response. The market, however, does not have the focus and the ability to necessarily do that. So it freaked out. As I learned more, I became less concerned about the DeepSeek threat and what that means for China as a competitor in the AI space. There's a number of things that stood out to me that made me think like, okay, this is no different than any time a Chinese company knocks off a American shoe brand or anything else. It's very similar, but there's more of a concern here. If we thought TikTok was a concern from a national security perspective, this is an even greater concern with its connections to the CCP through their app. So while there's definitely some interesting aspects of the open source code that can be used by Amazon or anybody to leverage, the actual app itself and the things as related to that, I'm less concerned about. In terms of what it means for U.S. companies in the tech space, this shouldn't be a surprise. It was always the greatest risk to technology companies in the U.S. was having somebody disrupt the market. But I think it's a bit overblown. And quite frankly, I think we've been complaining about valuations forever. And this solved our problem pretty quickly.
All right, let's move to Treasury yields. I heard the new Treasury Secretary say yesterday that he's kind of focused on the 10-year and bringing that down. Now, I'm kind of a student of history, and I have to go back to the early 60s and beyond, right up to present day. The 10-year seems to follow economic activity, and if you want to bring the 10-year lower, a sure way to do it is to lessen economic growth. I'm sure he doesn't want to do that.
Yeah, that's the conundrum here, right? You want to bring rates down, but at the end of the day, there is correlation there between the strength of the economy and the interest rate environment and the yield curve and how the yield curve behaves. The Fed doesn't have the power it thinks it has to control that. I mean, we've seen that in recent months with the Fed cutting and yet yield curve not behaving like rates have been cut. In fact, it's to be expected, right? Because you want to get out of an inverted yield curve, which requires the longer end to go up, even in a cutting cycle. But I think that the problem here and what they're trying to kind of fix is related to mortgage rates and the housing market. And I don't know that there's an easy fix to that. But I am concerned that there's this belief that if they just cut rates enough, they can fix this problem, because I think it's not that black and white. And there's a high probability of a potential mistake being made if they go in with policy decisions thinking that it is that easy.
Shana, I know you work with your clients talking about alternative investments here. Where do you see the greatest opportunity in alternatives here? Private equity, private credit, hedge funds? Where are you spending most of your time these days?
So more hedge fund-like strategies. Private equity, private credit are kind of sensitive to the interest rate environment and also sensitive to public market betas. In the hedge fund world, especially if you believe that there's going to be increased volatility, hedge funds and hedge fund-like strategies are great diversifiers. So for example, last week, there's a ETF, BTAL. It's the AGF US anti-beta fund. It's long, low beta, short, high beta. That product did remarkably well when we had the big DeepSeek threat sell-off. And that's exactly what you want in those types of products. And that's what hedge fund-like strategies can do, is provide you that downside protection when the market is under significant stress. Managed futures is another example, like a CTA ETF. And then when you move into the hedge fund space where they can use leverage more as a tool, you can get even greater benefit as a diversifier and as a downside protector. But it's not sexy, and people forget that like these aren't meant to outperform the market. They serve a purpose in your portfolio. I like to think of it as like home insurance. Like you hope you never have to use it, but you would never not have it because you need to be able to manage the risk. And that's exactly how I see those types of strategies. This year, I think, is the year where these types of strategies are really going to show their worth because I think the markets are going to be quite volatile.
Shana, thank you so much for joining us. Always appreciate getting a few minutes of your time. Shana Sissel, President and CEO of Banríon Capital Management, joining us here talking about the broader market share. One of the big movers in the marketplace today is